Okay, first of all, capital asset pricing model, CAPM, is pronounced CAPM. So if you want to sound cool around the water cooler with your finance friends, you talk about the CAPM, capital asset pricing model. And we are going to look at two assets here. We have expected return on the vertical axis. By the way, vertical means up and down. And we have standard deviation on the horizontal axis. Expected return is a measure of return. What is standard deviation a measure of?
Variation.
Okay, but we said it represents as a mathematical measure of? Starts with an R.
Risk.
Yeah, very good, thank you. It's a measure of risk. And so what we're really looking here is risk and return, right? And so the higher something standard deviation is, the riskier it is, the higher the expected return, of course, the higher the return. If I could get a huge expected return with no risk, I would be thrilled. But we know that there's this thing called the risk premium. The riskier things are, the more they have to return. Now, let's take a look at this. We have two stocks that we've discussed previously. There's Slowpoke, and we know the Slowpoke had an expected return of 10%, and its standard deviation was 10.49%, and so it says 10.5% here. And so that's how we've managed to plot Slowpoke on this chart. And then we have Supertech. And Supertech is out there with an expected return of 15 and a standard deviation of 24.1922. So that's why they've got 24.2. So there's no mystery where those two dots came from. But then there's this square, an unlabeled square. And underneath it says 14.93. It should say 14.95. So change that in your notes right now. Change that in your notes right now. It should say 14.95. Undoubtedly, there was some graduate student that was in charge of putting this chart together. They've been smoking weed. You know how this works. Okay, back to the story. 14.95, and it has an expected return of 13. Are those numbers familiar from our last discussion? What are they?
The standard deviation of both. Is that?
Okay, both how? Yeah, it's that portfolio that was what? 40% of one and 60% of the other. Now, I want to point something out to you. If you drew a straight line between Supertech and Slowpoke, would that portfolio return be above or below that line? Yeah, so if we draw a line between Slowpoke and Supertech, the little box would be above or below the line? Above. What this tells us is that the portfolio is getting a higher expected return than we would get if we were simply doing the weighted average of the standard deviations. You could either say it's lower risk or higher return. Either way would be correct. Okay, go ahead and label that as portfolio we just calculated, the square box. Portfolio we just calculated. Okay, now, here's what gets really funky. If I start generating every single possible portfolio composed of Slowpoke and Supertech, all the way from 100% Slowpoke all the way up to 100% Supertech, and I plotted those returns and standard deviations along a line, actually not a line, a curve. It would be that curve there. If we didn't have any diversification benefit at all, in other words, the correlation between these things was 1, the returns would be on that straight line between Slowpoke and Supertech. But because we do not have perfect correlation between these two, that line has a curve for it. Now, here's the fun thing. You might think, well, wait a minute, if I were really risk averse, by the way, you guys know what risk averse is? Okay, you're avoiding risk. If you're really risk averse, you would be investing at Slowpoke. But would that be smart? No, why not?
Because 1 and MB have higher expected returns with lower CPM.
Oh yeah. So what's better? Portfolio 1 has a higher return and lower risk than Slowpoke. And not only that, MV has a higher return and lower standard deviation of returns, in other words, less risk, than portfolio 1. And so the first one of these that I would be interested in even considering would be MV. By the way, what do you think MV stands for?
Minimum variance.
Ooh, very good. Minimum variance. Minimum variance. And then, as we increase, as we move towards super tech, we're adding more and more of the risky stock. The standard deviation of the portfolio goes up. We call that space between MV and super tech, we call that the efficient set. Efficient set. It's not efficient to invest below MV on that curve. Now, the whole darn thing would be the opportunity set, which is what's possible. Just because something is in the opportunity set doesn't mean it's in the efficient set. As my mother once told me, just because you can do something doesn't mean you should, right? You can invest between slowpoke and MV, but you shouldn't, because you can always do better by sprinkling in a little more super tech and a little less slowpoke, and that's going to reduce your risk until you get to MV.
So is everything inside the opportunity set?
We're not there yet.
Okay.
We're still on 2 assets, and while we're in 2 assets, it's only on the line, which is why we're calling it the efficient set instead of the efficient frontier, but you're getting ahead of us.
Okay.
Okay.
So on the line is the opportunity set or the
Yep.
fish? Okay.
On the line is the opportunity set. You will see when we get to multiple assets that it's more than that.
And can you just clarify what the efficient, then what is the efficient set?
The efficient set is between MV and super tech.
Okay.
MV to super tech. And this one is slowpoke to super tech. So you can invest between slowpoke and MV, but it's a bad idea. Good question. Other questions? Okay. I think I've told you everything. Oh, no. We need to talk about what motivates an investor to choose a portfolio along that line, MV to super tech. And the answer is risk aversion, which we've talked about just a little bit. Risk aversion is your desire to avoid risk. Do you think every human being shares the same level of risk aversion? No, we're all different. In fact, if you're rational, you are always risk averse to a degree. But do we also have irrational people? Yeah. Do you ever see people do crazy stuff and you're like, damn, no rational person would do that? And the answer is, you're right? Because we have irrational people. But if you're rational, you're always risk averse to some extent. But it differs from people to people. Let's talk about risk aversion and age. Who do you think is more risk averse, young people or old people? Old people. So, and it's a continuum. As you get older, you will become more risk averse. When I was 18 years old, some of my friends said, hey man, we're going to go jump out of an airplane. You want to go? By the way, obviously I hung out with stoners. So back to the story. You want to jump out? I'm like, how much does it cost? They said, $300. I said, no thanks. 7 years later, one of my buddies calls up. He's like, hey man, we're going to go jump out of an airplane again. Do you have the money this time? I'm like, yeah, I have the money, but I also have a great job. I just slogged my way through 4 years of engineering school. I have a great wife. I have a mortgage. I am not going to go jump out of an airplane with you morons. Now, obviously, our risk aversion did not change at the same rate, right? And I understand that smoking marijuana will do that to you. Back to the story. Now, 25, do you think I am more risk averse now than I was when I was 25? Oh yeah, 25 you're still like, oh yeah, let's do this thing, let's get these experiences, like that sort of stuff. And so you're willing to do things like ride a train up to the North Korean border. And when I went to China, I'm like in my 40s, and they're like, hey, do you want to take a train up to the North Korean border? I'm like, no thanks. By the way, the train to the North Korean border, the bathroom is a hole in the floor, and you can see the tracks whizzing by. Yeah, I don't recommend it. Back to the story. So, risk aversion, as you get older, you get more risk averse. Now, who do you think is more risk averse? Me or my dad? By the way, my dad is 81 years old.
Your dad.
My dad is staring death in the face every time he gets out of the bathtub, right? And he'll tell you, it's rough. The other day he jumped down off the tractor and like, now why at 81 is he still on the tractor? I have no idea. Anyway, injured himself. He's like, I don't know. I'm like, Dad, you're 81, stop that. Back to the story. Okay, so age is one of the things that pushes along this frontier. Now, what else do you think can, so two people of the same age, what else might drive differences? Okay, previous experience. If you previously touched the stove, you might know that it's a bad idea, right? What else? Let's just talk about basic human characteristics.
Greed.
Say again?
Greed.
Greed. Okay, so actually greed, we'll talk, so greed, yeah, so greed and fear are what drives this thing. Right now we're talking about fear. How about differences between genders? Let me ask you this question. You see these videos on YouTube of people doing absolutely stupid things that are dangerous. They are almost always men. Men are not as risk averse as women. Men are not as risk averse as women. Now, I know this sounds sexist or whatever, and there are plenty of non-risk averse females and plenty of very risk averse males, but as a general statement, women are more risk averse than men, and this may come down to the fact that they're smarter. I don't know. Like one person heard that. Okay, back to the story. So, my mom, who is the same age as my dad, do you think she is more risk averse or less? She's even more risk averse than he is. So, I'll tell you about their portfolios. My dad invests in dividend-paying firms. And he's investing for income because that's, you know, how you eat when you're old, right? Now, my mom, and of course, you know, at any house prior to 19, whatever it was, there are two kinds of money at the house. Whatever the man brings in is called our money. And whatever the woman manages to bring in is, can anyone guess? Her money, right? Okay, so where does my mom put her money? Well, she was putting it in CDs. She was so risk averse, she's in CDs, but then the recent low interest rates had basically forced her into buying some dividend-paying stocks. But until that change forced on her, and in fact it was greed. Who said greed earlier? Yeah, there you go. Until her desire for greater returns helped her to overcome some of her risk aversion, she was always in nothing but CDs. Does this make sense? Okay, so what's driving people along this efficient set? You should only be on the efficient set, but it's risk aversion. Risk aversion is what's driving people along that efficient set. Let me give you some examples here, and you can tell me where you think they're going to be invested. 95-year-old female.
Efficient.
Oh, there should be on the efficient set. You're absolutely right. But where should they be on that efficient set? Between MV and SuperTech, where should they be? Yeah, they're hanging out down around MV, right? 18-year-old snowboarder, male. Where? SuperTech, right? So you're starting to see how this works. 51-year-old finance professor. Somewhere in between, right? Does that make sense? Okay. Now let's talk about what causes the shape of that curve that is the efficient set, actually that is the opportunity set. And it's the correlation. If you've got a correlation of 1, the line is absolutely perfectly straight. If you've got a correlation of 1/2, you can see it starts to get a little bit of a bow into it. So there's a little bit of a bow to that line. And as that correlation goes further and further down, we see an increased severity to that bow. When we get all the way down to a correlation of -1, something amazing happens. How much is the risk? 0. How much is the return? It's positive. That's beautiful, right? No risk, positive return. And so, of course, the lower the correlation is, the better off we are. For each one of those, as we go to the left, is better, better, better. The very best would be over here on this vertical axis with a correlation of -1. However, is it possible to get two assets with a correlation of -1? So I'm giving this talk one night, and there's this guy, and I said no. And he said, well, what about the S&P 500 and the anti-S&P 500, which is some sort of ETF, which is designed to exactly mirror the S&P 500. I said, okay, you got me. There are actually things that are exactly perfectly negatively correlated. However, what do you think the expected return is on the S&P 500? Just take a guess. Whatever number you come up with will make me happy. 10.5, very good. Okay, so if the expected return on the S&P 500 is 10.5, what do you think the expected return on the anti-S&P 500 is? Negative 10.5. Let's hold a portfolio that is half of one, half of the other. Totally gets rid of all the risk. You must think you're a genius. However, what's the expected return on that portfolio? 0. Way to go. You've got a 0 risk portfolio and you're not even earning the risk-free rate. So let me put a condition on this thing. You got to have correlation -1 and both have to have positive expected returns. You got to have correlation -1, both have to have positive expected returns, and folks, it just doesn't happen. It just doesn't happen. So don't spend your life out there searching for that elusive pair of stocks that have a correlation of -1. You're never going to find it. Questions? Okay. Now, let's apply this to country portfolios. Remember, I told you that only insane people would be invested between Slowpoke and MV. And the first time I was giving this talk, I said, oh yeah, only insane people. And then I got to this chart, or this graph. I said, oh, wait a minute. I'm insane. Here's the problem. I was invested in 100% U.S. stocks. So what we've got here is an opportunity set that is a combination of U.S. and foreign stocks. By the way, if you're an American, foreign means everything other than U.S. If you're from somewhere else, please just play along with us, right? We assume your country is foreign. I know it's not foreign to you, right? Mr. Oswald, you're not from the U.S., are you? You are? No? Okay. Sometimes I think he just messes with me. Okay, back to the story. Where is our minimum variance portfolio? It turns out that it's at the 80% U.S., 20% foreign point. Because these things are not perfectly positively correlated. Now, the U.S. is undoubtedly positively correlated with what we call the ROW, rest of the world. But it's not perfect positive correlation. And so when we sprinkle in some of these risky foreign stocks, we are actually able to reduce the risk versus carrying only U.S. stocks. Knowing what you know about diversification, this makes total sense. But if you ask your average retiree, should you have foreign stocks in your portfolio, what will they say? No, they're risky, right? But it turns out that sprinkling some of this risky stock into your portfolio actually reduces your portfolio risk because they're not perfectly positively correlated. Now let's discuss why foreign stocks are risky compared to U.S. stocks. Now, the first thing that I would point out is growth. Growth in the rest of the world is notably higher because we've still got a lot of countries that are trying to develop their economies, and so they're growing a lot faster than the U.S. So we have developing economies versus developed. We also have the institutions. In the United States, we have good legal protections for shareholders. And you might think that you need to go to some absolute anarchical place like, say, Somalia in order to have no protections for shareholders, but it's not true. There's actually a continuum here. And you can see that even investors in, say, France are not as well protected as investors in the U.S. And there may be places that are more protected than the U.S., but the point is there are some places where investors have very little protection. And so we're going to chalk that up to institutions. You could also say law. And then there's political risk. I'll start with an example of political risk elsewhere. The year is 1975. My dad is invested in a stock called Texas International, which, Texas is in a country, I'm not sure how that works, but Texas International. And it turns out that every bit of Texas International's operations, which were in the oil field, were in a country called Venezuela. Now, let me tell you about Venezuela. Venezuela, since the late 1950s, had been riding high on an oil boom, and so there were a lot of people getting rich. Here's the problem, though, when you let people get rich. Does everybody get rich? No, not everybody gets rich at the same rate. Now, everybody tends to be better off, but not at the same rate. Now, if your income has grown, but it hasn't grown as fast as someone else, there's this emotion that takes over. Are you guys familiar with this one? Okay. Now, what happens? Politicians know, here we've got some basic human emotions. Can we all agree these are basic? Yeah, okay. Now, politicians know that people are greedy. They're rationally self-interested would be a better way to say that. They do suffer from envy, and they also suffer from fear of the unknown. So what if I, as a government, say, you know what, I'm going to come in here and I'm going to take money away from these rich people who've been holding you down, and I'm going to give you some of that money. Does that sound good?
Oh, yeah.
Oh, yeah. Woohoo! Okay, and then I say, and I'm going to guarantee you that you'll always have a full stomach and a full tank of gas. How do you like that? Does that sound good? Okay, so here's what happened. In Venezuela, 1975, we had this widening wealth disparity. I think it was 75, it was sometime around that time frame. Widening wealth disparity, and so of course we get these, and sometimes they'll call themselves populists, they're actually socialists. Socialist political people would come in, and they're like, okay, we're going to do all this neat stuff for you. And people are like, yeah! And so they vote for these people, and they get in office. Now, one of the first things they did was to nationalize the assets of all the foreign companies. Nationalize. What's another word for nationalize? Steal. Did they pay for those oil rigs? No. Did they pay for the pumps? Did they pay for the drill bits? No. They didn't pay for any of that. And yet suddenly now it's up. We've nationalized your company. Oh, here's 12 cents for your trouble, right? Because then we can say we paid for it. It's all good, right? Okay, so this is one of those risks that you face when you do business in other countries. Now, as a result of that, knowing what you know, what do you think the returns have to be to get people to invest in Venezuela? It's got to be high, right? Has to be these pretty high return projects or no one's going to do it. In fact, what's going on in Venezuela right now? It's bad, right? She's a neighbor close, right?
Well, we're going on the same direction.
Oh, yeah, okay, well, we'll get to your country in a second. Okay, so Venezuela goes through a cycle. It's like every 20 years or so. Oh, by the way, let's talk about the rest of the cycle. The government takes the stuff away, and who do they put in charge? Do you think they put people in charge who know what they're doing, or do you think they put friends and allies? Friends and allies, right? And now you've got people running an oil company that previously were like the press secretary for El Caudillo, which is like the strongman, right? Do you think they know anything about running an oil company? No, but they do know about stealing, right? Because they're part of this group that steals. And so the corruption and basically everything just goes to hell. And does anybody have any motivation to try to start a new business? No, because what's the government going to do if you start it? They're going to take it away. At the very least, they'll just tax you at like 90%. So you're like, screw it. I'll sit here and I will just collect my monthly payment and everything will be fine. Now, when everyone says that, what happens to the economy? It goes in the toilet. Now, let's ask about toilet and toilet paper in Venezuela. Yeah, they don't have any toilet paper. Can you imagine a life without toilet paper, people? Oh, who said that?
Scopy did.
Yeah. Okay, so are you from one of those cultures that uses the water and whatnot?
Yeah.
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 Okay. Can you imagine a life without your cup of water?
Yes.
You can.
I can use toilet paper.
Can you imagine a life without toilet paper or the cup of water?
No, that's a problem.
My dad worked with a Pakistani guy, and he was of the water group, right? And he would go to the bathroom before my dad. My dad would go in there, he's like, Habib, it looks like a duck's been playing in here, because it was wet everywhere. Cultural differences. Everyone should respect each other's, hey, if you want to use your mouth, great, but just wipe the seat when you're done, please. Back to the story. Where were we? Okay, so we were talking about nationalization. And so here's the trick. Pretty soon, everybody gets really down, and they're like, you know what? This sucks. We were better off when we had capitalism. And so what do? They elect someone that promises to clean this mess up. And they do. And then businesses start to grow and flourish. But do you know what happens next? Oh, and the whole economy comes up. Everybody's better off. But what happens next? Some people start to get rich. Right? We're all doing better, but he's getting rich. I'm just getting better off. Oh my goodness. What can we do about that? And we're right back where we started. I gave this talk and I told that Venezuela goes through this like roughly every 20 years. And I had a student from Argentina and she laughed. She says, my country does it every 10. Does that sound about right? Yeah. Okay, so that's what we're talking about, the kind of risks that you see when you're investing in foreign stocks. Do I think that you should invest in foreign stocks? Yes. You should hold a diversified portfolio. Are there some countries that I would avoid altogether? Yes. Venezuela, right? Venezuela, Zimbabwe would be another one that I would avoid. By the way, this one might freak you out. Right now, a good place to invest? Rwanda. What's going on in Rwanda?
The economy is really booming.
Why is the economy booming?
The guy who's doing the thing.
The guy who's doing the thing!
Great explanation.
Nice.
Is it just a guy? No, it's what the guy's doing. He's putting in place law and institutions that protect investors, that protect individual rights. And this is like a new thing in that part of the world. And so he's actually, in fact, Rwanda is now they're targeting becoming the Singapore of Africa. And yeah. And so let me run you through it where Rwanda came from. 1994, the year I graduated college, Rwanda was in the middle of a genocide, and there were like bodies and limbs and torsos floating down the major river and like gathering on stuff. So they've come a long, long way. Now, what do you think the growth rate in their economies looked like between 1994 and now? Right? Really good. Questions? Yeah.
So I've always been with like China,
Mhm.
obviously there's lots of, it's communist, but
Yeah.
they encourage capitalism because there's billionaires and foreign investment.
Uh-huh.
I don't understand.
Okay, it's the same cycle. Roll back to 1976. Mao Zedong dies, right? And so now they've got some time to think about, and by the way, what's the state of China in that time? Are they rich or are they poor?
Poor.
They're poor. So they're motivated. And they look out and they see that capitalism can actually lift them out of poverty. But they're a little reluctant, but they do, they're stage by stage, they release some parts of the economy, right? Not the whole thing, some parts. And suddenly, people start to get rich. And the Communist Central Committee, or whatever it's called, they asked Deng Xiaoping, they're like, holy crap, we've got people getting to be rich. And what does he say? We have to allow some people to become rich first. Now, he said that in like 1979, 1980. It was prophetic, right? So we roll up through all the way up to 2012. They're still letting people get rich. And then starting in 2012, they're like, wait a minute. The rich are getting too rich. By the way, typical Chinese person, better off, worse off than they were in 1979.
Better.
Better off. I know people that were in China in 72, and they said for everyone in the family, they had one set of clothes. So if you were going anywhere, you put on the clothes, right? I'm not kidding. That's some rotten stuff. Do you think everyone in China has clothes now?
Yeah.
Yeah. So they're still better off, but wait a minute. I see these guys driving Lamborghinis and Ferraris, and that's just not right. I need to get some of that. And by the way, everything could go to hell tomorrow. Wouldn't it be great if the government guaranteed that they would take care of me? And so we're seeing that same regression. Does that make sense?
So yeah, it's so confusing right now because their economy is like suffering so much, but they won't.
Yeah. Okay, so let's talk through some of the things. I know this is not an international finance class, but number one, when you have a centrally planned economy, which they still do, you end up spending money on things that are politically favored, not necessarily things that are going to improve the lives of people. Example, there's a high-speed train system that goes out to Xinjiang, and like 5 people ride it every day. It costs billions to build. Is there any way that they're ever going to pay that back? No. So that's basically the government's having to pay the mortgage on this thing, and nobody's helping them by buying tickets. And so you see centrally planned government, they've got a lot of wasteful infrastructure spending. How did they finance that spending? By issuing debt. Who did they get the debt from? Who did they borrow from? State-owned banks, owned by the same government that is building the railroad. So everything sounds good so far, except for one thing. Whose money's in the banks? Yeah, the people's. Now, the chickens are coming home to roost. And by the way, they did this with real estate too.
Yeah, I heard about that.
The chickens are coming home to roost because these assets aren't producing enough cash flows to pay the debt. And so the Chinese people, rightly so, say, wait a minute, I might not be able to get my money out of this bank. And so they show up down at the bank and they try to get all their money out. And as of late, they've been limited to 1,000 yuan per day, which is like 160, oh yeah, you know what I'm talking about, right? Because you live there. Yeah, it's $160 a day is the most that you can get out if you're lucky. If you're one of the 4 banks that have recently had real trouble, you can't get squat. Yeah. Okay. So then you got COVID, right? I mean, this is one thing on top of another. It'll be really interesting to see how this all turns out. Okay. Whew. Okay, back to the story. What's going to push you between this, the 20/80 portfolio and the 100 portfolio? Once again, it's just risk aversion, right? Would you invest in 90% US, 10% foreign? You shouldn't. It's inefficient. Now we are on to what you thought of earlier, and that is the extension to many assets. in this blue field, don't let that bat wing design fool you. Apparently blue ink is just too expensive to continue to draw, so they just bat wing it, right? Okay, so that blue area represents every risky asset known to man. The blue area includes every risky asset known to humankind, and we can form portfolios throughout that region. And so portfolios W, 1, 2, and 3 are all part of the opportunity set. You could do any of those. They're all entirely possible. However, they would not be efficient. And in fact, now instead of saying efficient set, we say efficient frontier. Oh, I misspelled frontier there. The efficient frontier. Okay. That means I would only be interested in investing along this line that I can only refer to as being the color of baby poop. You see it? Maybe light brown would be less offensive. But anyway, so there we go. Between MV and X is your efficient frontier. Now, where would we invest? Would we prefer to be at W or R? Yeah, we prefer to be at R. We can always move up from any portfolio in that efficient, or the opportunity set up to the efficient frontier, and either gain return by going up, or we could reduce risk by going left. As a result, portfolios W, 1, 2, and 3 are all inefficient. They are all inefficient. I can tell you 2 ways to make your life better for any of those. I can either go up for more return, or I can go left for more risk, less risk. So I love more return, I hate risk. So either one of those things makes your life better. But you would not want to be invested in those suboptimal portfolios. And then, so now we say you are moving along this line, MV to X. And what do you think is pushing you along that line? Oh, come on, we've already talked about it twice.
Risk aversion.
Yeah, your risk aversion is what's pushing you along that line. Okay, now this brings us up to about 1964. About 1964. And so this is actually fairly recent, compared to the discovery of gravity. Fairly recent event that we've come into this idea of, wait a minute. Oh, and I want to point one more thing out to you. Check this out. As I'm moving from MV to X, I want you to notice that the slope at first is steep. What is slope? It's the change in, it's rise over run. So it's the change in the vertical divided by the change on the horizontal. And so in the beginning, when I move away from MV, if I take on just a little bit more risk, I get a lot more return. But what happens as we start to move away from MV? What happens to that slope? It gets less and less and less. And if I want to get another single unit of return, I have to take on more and more risk. Do you see that? Okay. Now that we've said that, it turns out that there is an asset that we've totally been overlooking. Remember that the blue field represents every risky asset known to man. But there's one more asset out there. What's it called? I'll give you a hint. It's in the name of the slide. Yeah, it's the risk-free asset. The risk-free asset. And the risk-free asset provides the risk-free return. And how much risk do you think the risk-free asset has? This isn't a trick question. There's a book about it. None! Which is why we've got it over here at a standard deviation of 0 with an expected return. And by the way, it's not just expected return, it's known with certainty. Remember, we said that expected return is a scientific wild-ass guess. It's like the weather forecast. But if there's no risk, then we know the return of the risk-free asset with certainty. And so we just call it the risk-free rate. And so there it is, right up there at 0 and then at a positive amount of return. And it turns out that I can mix that risk-free asset with any risky portfolio represented in that blue area. And I can connect those two by a line. And as I add more of the risky asset, my return goes up. But this time, the slope remains constant, which is a real cool thing, because remember previously, if you wanted to increase return, you had to keep taking on more and more and more and more risk, right, exponentially. Well, here, now that we figured this thing out, we can invest along this straight line, and we can control exactly how much risk we want to take for the return. The slope is the same all the way along. Now, here's how we do this. Imagine that there is a pen back here at R sub f. And I'm going to take this line and I'm going to raise it. And I'm going to keep raising it. As long as it contacts that blue field, it's part of the opportunity set. There is one last point at which this thing is possible, and that is when it is tangent to that blue field at exactly 1 point. What does tangent mean? It touches at exactly 1 point. That's what tangent means. And so when we get there, we're only going to be intersecting one portfolio. We're only going to be intersecting one portfolio in that field of risky assets, and that portfolio has a special name. We call it the market portfolio. In this picture, it is represented as A. The market portfolio is represented as A. Now, theoretically, what do we think is in this portfolio? Because I know you guys are all dying to buy it. And here's why. Because the slope of that line is the very steepest you can get, right? You're getting the absolute most return for every unit of risk that you assume. Does that make sense? So we want that line to be as steeply sloped as possible, and that's, in fact, we call that line now the capital market line. Line 2, the name for that is the capital market line. Just, it's on your slide, just make sure you circle that. That's the capital market line. And the capital market line only has two assets in it. It's got the risk-free asset and it's got the market portfolio. But what is this market portfolio? Get ready to write. It is every risky asset known to man. Every risky asset known to man. And when I say man, I mean humankind. Every risky asset known to man. Held in proportion to its importance in the world economy. So it's every risky asset known to man held in proportion to its importance in the overall world economy. And how do we know the importance of something in the world economy? It has to do with its market value. So if we have 100 shares and they're each 1,000 apiece, 100 times 1,000 gives us 100,000. That's going to be and then we're going to divide that by every market value of the sum, and that would give us a weight for this, just like in a regular portfolio. That's what we mean by held in proportion to its importance in the world economy. Now, there's a problem. This is a theory that we cannot test. It's a theory we cannot test, and here's why. Because if we were to try to create this portfolio, we could easily deal with the stocks that would be in the portfolio because we know their values. We could easily deal with the bonds. By the way, are bonds risky assets? They're not as risky as stocks, but they are still risky assets. Even government bonds, long-term government bonds have risk. Remember that from Chapter 10. And so we can easily figure out the returns on those bonds, the returns on the stocks, their market value of both. But what else is there out there in the world economy? What other assets can you think of? Anybody here own a house? Oh, good for you at this point. So I own a house. My wife and I own the house. And under the laws of Missouri, half the house is mine, half the house is hers. This is the theory, right? So, so that's an asset that we own. Is it a risky asset? Yes, Ms. Wabi says yes. It's so funny. When I was teaching this before 2007, students would say, no, houses aren't risky assets. Real estate values always go up. 2009, I'm teaching this, and they're like, oh yeah, house values always go down, right? And the truth is somewhere in between. But my point to you is, it's a risky asset. I lost $39,000 selling a house to get out of Mississippi. Now, I will say it was $39,000 well spent, but that's what it cost me to get out of Mississippi because house values were down. It's a risky asset. You can lose money. Okay, now the next question is this. Now that we know that my house is a risky asset, can you purchase shares in my house? No. And do we have up-to-date price information about my house?
No.
No. The only thing that we know is that that house was sold in 2007 for $354,000, $354,500. That's what we know. Is that a fresh data point? No, that's 15 years ago, right? My point to you is this. We cannot get good value information or return information for every risky asset out there. And so there's no way for us to test whether or not this thing really works. And so that's the criticism of it. But we do know that this does, this theory is among the best explanations for what we see in reality. And so until someone comes up with a better theory, this is what we're sticking to. Okay, now let's talk about this line and investing along it. If you're very risk averse, where are you at? My mom, where's she at? Yeah, she's over here at the risk-free asset, right? She's, and by the way, let's say my dad might be at location 4. So what's pushing you along this straight line? Once again, it's risk aversion, right? And then you got me. I am right now at location A. I don't own any of the risk-free asset. I am totally invested in risky assets, so I am at portfolio A, which is the market portfolio. And we'll talk about how I'm at the market portfolio since I can't buy a piece of your house, right? And then, so by the way, we're looking at 0% of portfolio A over here at the left. We're looking at 100% of portfolio A at A. 4 is a mixture of the two. What in the world is 5? How can we go beyond portfolio A? I'm going to give you a hint. Buying the risk-free asset is loaning money. All I have to do is get the weights to add to 1. How could I have 120% of portfolio A in my portfolio? What's the only way mathematically that that could possibly be true? What would the weight on the risk-free asset have to be? Oh, come on, you guys can certainly subtract 100% from, or 100 minus 120. It's got to be negative 20, right? Because if it were positive 20, we'd have 140%, and you can't have that, right? So how would we end up with negative risk-free asset? If buying the risk-free asset is loaning money, Mr. Taylor, what must negative be? Yeah, what's the opposite of loaning? Borrowing, right? And so if we borrow at the risk-free rate, we can actually have negative risk-free asset in our portfolio. And you say, okay, how in the world could I possibly borrow at the risk-free rate? Because I'm not the United States government. Well, it turns out that you can get really close borrowing on margin. Do you guys know what margin is? What's margin?
It's like using, I don't know like exactly the technical term, but like if I go to my brokerage account, I can use their money and invest it into something.
So you've got $100,000 of your own money,
I wish, but yeah.
Well, no, you got $100 of your own money. Is that closer to, yeah, okay. You got $100 of your own money. You can put it in your brokerage account and you can buy more than $100 worth of stock because you can borrow on margin from the broker. Now, the broker will loan you this money at a relatively low percentage rate because there are two things going on here. Number one, the broker wants you to buy more stock because, not Robinhood, but all brokers have typically gotten commissions for selling stock. Does that make sense? And by the way, Robinhood is making money every time you buy and sell stocks. They're just throwing you into the dark pool to be molested by other investors. But back to the story. I'll tell you about that some other day. Oh yeah, it sounds dark, doesn't it? Because it is. Okay, back to the story. It's kind of like the free drinks on ladies' night. Don't fall for that. Those drinks aren't free. Back to the story. It's gone really dark, hasn't it? Okay, so back to the story. They want you to buy more stock, and they also, they're okay loaning you money at a really low interest rate because they have very little risk. Can anyone explain to me why they have so very little risk based on the amount of money that they loan to you? What can they do?
They could just take the future returns in your portfolio, right?
Okay, so let's say that you take your $100 and you go out and you borrow another, oh, by the way, the Federal Reserve will allow you to borrow another 50%. So let's say you go whole hog and you're up to 150. And stock prices are going up, you're happy, you never hear from your broker. Stock prices start going down. At some point, when prices get low enough, they're going to call you with what's called a margin call. They're going to say, hey, you need to put some more money in because you're getting low. And if you get a certain amount of low, it starts to give risk to this debt that this money they loaned you, right? And so you say, hey man, I'm a student. I don't have any more money. Do they say, oh, don't worry about it? In a way they do. They say, don't worry about it. What we're going to do is we're going to sell enough of your stock to get you back down to where you have an acceptable level. So we're going to pay down that money that you owe us by selling your stock. Does that make sense? And so basically, as long as stock prices don't go to zero in an instant, these brokerages can stay ahead of these issues where they might end up losing money because they loaned that money to someone. Does that make sense? Okay, so you can actually borrow on margin out here and invest at 0.5 and get a return greater than that offered by the market portfolio. But we know that the risk is also higher. If you are on this 50% margin kick that we just talked about, you're also taking on 50% more risk. And when the market's up, you are 50% better off, but when the market goes down, what happens? You're 50% worse off, right? Does that make sense? Let's talk about what moves stock prices. We know stocks have an expected return, and we know that it's the arrival of news that moves stock prices. And so because otherwise, everyone's going to, if we incorporate all the information that we know into the stock price right now reflects all the things that we know. So the only things that are going to move this stock are going to be things that the arrival of things we don't know, right? Could be good news, could be bad news. Now, it's not just news in general, it's actually the unexpected portion of news. Let's say everybody expects Joe Biden to win the election in 2024, assuming he's still alive. Everyone expects that. Should there be a change in stock prices the next day if he gets elected?
Yeah.
There will be
There usually
just a little resolution of uncertainty. But will there be a bigger stock market move if the other person wins? Yeah, because that was unexpected news. Now let's take this down to a really boring level and talk about expected return or expected earnings per share. the company says, we are going to, or the analysts have said, we think the company's going to return or earn $1 per share. We think the company's going to earn $1 per share. And then the company reports its earnings and it reports $1 per share. How much was the unexpected news there? None. It's exactly what we expected. Stock price shouldn't move at all based on that news. But what if the company comes out and says, wait a minute, we actually made $1.04. What should happen to the stock price? It should go up. Because of the dollar? No, because of the 4 cents. We have positive 4 cents of unexpected news. Now, what if the company says, it's actually just 96 cents. Now, there's the expected news of $1 and the unexpected news of negative 4 cents. What do you think happens to the stock price? It goes down. And in truth, there's actually an asymmetric effect. If we had 4 cents on the good side, you'll get a bump like this. And if you have 4 cents on the bad side, you have a drop like this. What do you think companies are incentivized to do? Underestimate. And they try to talk to all the analysts. They're like, dudes, we don't know. I'm not sure. We're not sure how things are going to go this quarter. So they try to talk them down, and then you guys are the analysts. You all say, well, maybe it's only going to be $1. And then I'm like, woo, it's $1.04. And we have a big party, right? Now, how can I prove to you that managers actually do that? 2/3 of earnings reports beat expectations. At most, randomly, 50% should beat and 50% should fall below, right? Not assuming hitting exactly. 2/3 exceed. And yet, what do analysts continue to do? Play this lowball game? Oh yeah, so there's some behavioral problems going on here, some behavioral issues. Okay, so it's the unexpected portion. Now, those unexpected portions are expected to average 0. If they didn't average 0, let's say that over the last 5 years, the unexpected pieces of news added 1% to the return of the stock. What would we do? We would revise our expectations. So previously, we expected this stock to return 10%, and it has been consistently returning instead 11%. What do? We change our expectation. In statistical terms, anyone that behaves in this way is a Bayesian, where you are incorporating new information to change your thought pattern of what you expect to happen in the future. Let's see. I'll give you an example of this. My wife and I have this Ring doorbell, and it's also our security system. And it has where you can turn off your alarm from the phone, right? By the way, my phone has a passcode on it. Don't take my phone thinking you're going to break in my house. Okay, back to the story. Every time we're on the way home, my wife gets out the phone to turn off the alarm. And it says, this is taking longer than expected. Every single time, the phone says, it's taking longer than expected to connect to your system. And my wife every time says, adjust your expectation, right? If you continuously have a surprise to one side or the other, adjust your expectation. Does that make sense? Next time, we're going to talk about 2 kinds of risk. And these 2 kinds of risk are very important for our understanding of both return and risk under diversification. See you next time. Okay, so saving for retirement. Right now, let me guess, your income is somewhere between jack and squat, right? Okay, so you're used to being poor, am I right? Okay, so here's my advice to you. When you get your job, you're going to be making more money than you've ever made in your life if you're normal kind of MBA student. So here's what you do. First of all, max out your 401k contribution. And if you don't know what 401k is, just Google that. Max it out. And you want to max it out, and the reason you do is two reasons. Number one, you're not going to miss the money because as we've just figured out, you guys are poorer than dirt, right? You're not going to miss that money. And number two, what do we know about compounding and time? Oh yeah. So it's going to, if the sooner you start, the more money you'll have. Does that make sense? Okay. Now, the next thing is you're going to get raises along the way. Instead of taking that money and blowing it on, say, better beer or whatever it is that you folks do, think about saving that additional money because once again, you'll never miss it because you never had it before. And if you follow those simple steps, then you'll be in good shape when you get to be however old. By the way, raise your hand if you think Social Security is going to be there for you. Yeah, you notice I'm not raising my hand either. So somehow I was born at the suckiest time because, I've been paying Social Security my whole life, but the year that I'm supposed to start drawing it is the year they say it will be going away. So isn't that great? Yeah. Anyway, so that's my advice for saving for retirement. Now, the other thing I will tell you is that I made a mistake in class the other day. I lumped normal and luxury goods together and inferior goods separate. Now, I was right about inferior goods. It has a price, an income elasticity of demand of less than 1. What does that mean? If your income's down 40%, maybe you're only down 10% on the amount of this product that you're going to demand. Let's say toilet paper, right? But what if we have a product that it goes exactly with your income? So if your income doubles, you will consume twice as much of this. I don't have any good examples of this thing right here. Luxury goods, we know what those are, and the demand for those climbs faster than your income. So, how do I put that? When you get if everybody got 10% more money, the demand for BMWs would go up by more than 10%. Does that make sense? Because it gives you that ability to move up from the Acura to the BMW. Okay, so that's. And I wanted to straighten that out with you because I did mess that up the other day. Are there any questions? Okay, now let's get back to systematic risk and asystematic risk. By the way, we talked about news and stock prices, and we said that news is what moves stock prices, and that it's got to be unexpected news. Because if the news was expected, what has already happened to the stock price? Yeah, it's already priced that information in. That's one of the things we talk about in the efficient market hypothesis. By the way, efficient market hypothesis says that if you read in a newspaper about a new hot stock, can you go out after that newspaper, you get the newspaper, you're like, oh, that's great, and then go out and put a trade and make above market return on that? No. In fact, the only time I did that, back when I was a stupid engineer, the only time I did that, the company actually went bankrupt. So, yeah, good call. Okay, so that was when I canceled my subscription to Business Week, and we were done. Okay, so now let's talk about risk. Remember we said risk and return go together. And so far we've been using standard deviation as our measure of risk. But we need to be clear that that is total risk. Total risk. So standard deviation is a measure of total risk. And it turns out the market's not going to reward us for bearing all risk, just a certain kind of risk. And that certain kind of risk that they're going to reward us for bearing are systematic risks. These are risks that influence a large number of assets, sometimes all assets. For example, Russia invades Ukraine. What happens to the price of oil?
Increases.
Yeah, it increased. Now, can you give me an example of any business at all that is not affected by an increase in oil prices? No, I'm glad no one tried, because if you had, I would have been able to tell you, well, their stuff actually has to get to the store in a truck, right? Okay, so that's a systematic risk. And there are all sorts of systematic risk. There are ones involving the prices of commodities. There are ones involving financial decisions. The other day, the British said they were going to cut taxes. And it hit the financial markets all over the world. So there are these systematic risks, and they impact everything. Then we have unsystematic risks, and these are things that only impact a few things. So I'll give you an example here of an unsystematic risk. Are you familiar with Will Fisher Distributing? Does anyone know what Will Fisher does?
Yes.
What do they do?
Distributes beer for Anheuser-Busch.
They distribute beer for Anheuser-Busch. And the reason one of the students was in my class, he still works there, and my wife and I take our Chinese students out there for tours of their facility, and then we get free samples. But that's, of course, I don't drink on the job, right? Oh, back to, students love it though. Back to the story. Will Fisher Distribute. They have an area in which they are allowed to distribute beer. Now, if you go to the west, it's another distributorship. If you go to the east, it's another one. If you go north, it's another one. South, it's another one. Now, and I'm not wishing this on anyone, but let's assume a giant sinkhole opens under the Will Fisher distributorship and swallows the whole thing. I assume there would be a large belch afterward because of all the... Okay, back to the story. So, a sinkhole opens up, swallows the whole thing. Is that a systematic risk or an unsystematic risk? It's unsystematic because it's only affecting the one. And now, let's talk about why you can diversify away from such things. What do you think's going to happen if Will Fisher just goes into the big sinkhole? Do you think we're going to go thirsty in Springfield? No, what's going to happen? Yeah, do you think Anheuser-Busch would give those other distributors emergency ability to come in here and fulfill the needs of a thirsty and devastated Springfield? Absolutely. And if not, is there another distributor here in town? Yeah, someone's got to put Miller Lite out, right? 'Cause the Will Fisher doesn't do that. And so what I'm telling you is, if you had a portfolio of all the beer distributors, would you really be impacted all that much by this sinkhole that swallowed the one? No, because the profits of the others are going to be up while the profits of Will Fisher is down. Does that make sense? Okay, let me give you a bigger idea on this. This is the reason that we can diversify away from some of these things. Let's talk about the movie industry. What do you think determines the fluctuations in revenues at studios more? Economic conditions or whether the movie's any good? Oh, no. So think about this. You make Spider-Man, and the Spider-Man movie comes out, and you're like, I want to go see that. Do you really think, we may go into a recession in the spring? I don't know. No. In fact, strangely enough, movies do slightly better during times of recession. Anyone know why? Yeah, it's escapism, the same reason cheap alcohol does well. Okay, but it's minor. It's a minor effect. What's a major effect? I'll give you some examples here. Roll back to 1998. Every woman I knew had seen Titanic about 3 times. Yeah. Jerk. Okay. Every woman I know had seen Titanic like 3 times. Titanic was, at the time, I think, the biggest grossing film of all time. Of course, it's been surpassed since then. What do you think the revenues looked like at that studio at that time?
Very high.
Very good. Now, let's, and I don't know if it's the same studio, but let's assume it is. And then, not long after that, they come out with Paul Blart Mall Cop. Have you seen this?
Yes.
Oh my goodness. Okay, what's my point in this? The revenues at a movie studio have a whole lot more to do with the blockbuster nature of the films that they're turning out than it does from economic conditions. Now, here's the next thing. Do you think we've only got one movie studio? No, this isn't North Korea. We've got more than one, right? What's that?
We're getting there.
Yeah.
Disney keeps buying.
Consolidation, yeah. Oh my.
We'll
Okay.
be done with Disney Universal soon.
Yeah, pretty sad. So you guys need to go out and start a new movie studio. Yeah, okay. But keep in mind though, we have new entrants into the movie making business. Who are they? Netflix, Amazon, Hulu. So it's not all going in the toilet like you think it might be. Okay.
Hulu's owned by Disney.
Ish.
Like everything else.
Yeah. Hulu's ish owned by Disney because it's actually, did they buy out the rest of it?
I'm not sure.
Okay, you need to check on that before you start making such sweeping statements. I'm just messing with you. Okay, back to the story. Now, let's think about this. At the same time that this movie studio is putting out Titanic, someone else is undoubtedly putting out Dude, Where's My Car? Have you guys seen that one? Oh my. Oh, Mr. Bauer, you're fortunate you've never seen that.
It was an experience.
It was, yeah. So what I can tell is, just from the bit that I saw, is it could probably only be enjoyed with the accompaniment of a mind-altering substance. But we'll get, so beyond that. Okay, so at the same time, but now, here's the trick. Do you think every movie studio releases stinkers at the same time? No. Do you think they all release blockbusters at the same time? No. And so the revenues of these movie studios are uncorrelated. And so I could get rid of a whole lot of risk, this unsystematic risk of stinker or blockbuster, by just holding a portfolio of all the movie studios. Does that make sense? Okay. Now, the market knows that you can get rid of this risk. Now, and I talk about the market like it's a sentient being, but it's actually acting like a sentient being, but I'll explain how this works. If you think back to the very last statement I made in chapter 4, which you were supposed to have watched that video, and I doubt you did, but here it is. The price or value of anything is the present value of the expected future cash flows discounted at a rate appropriate to the risk. Now, present value, future value divided by 1 plus r to the t. If I am taking on the total risk, if I'm undiversified, and this is the only stock that I'm owning, I'm having to take on all of the risk. As a result, my demanded return will be higher, and I'll be willing to pay less for that stock. Does that make sense? It's worth less to me because I haven't taken on all this risk. Now, if everybody out there was only going to buy one stock, everything is still cool. Except for one thing. There are people like me out there who are well diversified. So I don't have to endure total risk. I only have to bear systematic risk. Now what does that mean? It means that I can accept a lower rate of return for owning the same asset because I'm not taking as much risk as you first stock buyers. Does that make sense? So as a result, what does that mean? It means I can pay more for the same asset because the risk is lower, my required return is lower, and I can pay more for that asset. And so if you think of the market as being basically a bidding war, who is always going to win the bidding war? The diversified investor. And that the risk that's getting priced in isn't the total risk, it's only the systematic risk. It's only the systematic risk. And that's why we say the market only prices in systematic risk. Now, does that mean that you couldn't still go out there and buy that one stock? Of course you could. But you would not be getting a return high enough on that stock to pay for the amount of risk that you're taking. Does that make sense? Of course you can go out there and buy it. People overpay for things all the time, right? But you're never going to win an auction against these people who can afford to pay based only on the systematic risk. And that's why stock prices only reflect systematic risk. And so we have some names here. Let's talk about these. Systematic risk, we have another name for it. By the way, these are all names that get used interchangeably, say in homework and test questions. Systematic risk, another name is market risk. Another name is market risk. Another name would be undiversifiable risk. Undiversifiable risk. Because we can't get rid of this stuff by diversifying. We can't get rid of it by diversifying. Then we have unsystematic risk. And unsystematic risk, I'm going to go ahead and write this one out for you. We also call it idiosyncratic risk. Idiosyncratic. There's your $7 word for the day, idiosyncratic. Used to be a 50-cent word, but inflation, you know how that works. Okay, idiosyncratic risk. Idiosyncratic means basically that it's not with the others. So when we talk about someone exhibiting idiosyncratic behavior, I went to high school with a guy that walked into a McDonald's wearing no pants because the sign said no shirt, no shoes, no service. He went in and demanded service with no pants on, right? We would say that behavior is idiosyncratic. Do you see a lot of people doing that? I should hope not, right? Okay. Idiosyncratic risk is the same thing as unsystematic risk. We may also hear it called firm-specific risk. Firm-specific risk would be another name for this. And you may also hear it called asset-specific risk. And then finally, we call this kind of risk diversifiable risk. Diversifiable risk. Because you can get rid of it through diversification, just like buying all the movie studios or all the beer distributorships. Okay, can someone tell me which of these can be diversified away?
Unsystematic.
Unsystematic. It's actually on the slide, right? Which one of them are you stuck having to deal with? Systematic. Which ones do well-diversified investors endure? Systematic. Which ones do people who only own one stock endure? All of them, right? And in fact, we could say, remember earlier I told you standard deviation is a measure of total risk. Total risk is just systematic plus unsystematic. The total risk is just the systematic risk plus the unsystematic risk. There are only two kinds. You add them together, that's your total risk. I say add them together. We're going to see mathematically we can't really do that. So let's talk about how the number of stocks impacts diversification or the portfolio risk. And what happens here is some of my fellow finance folks went out and they trained a computer. And they trained this computer to do what's called a Monte Carlo something or other. Anyway, the idea is it's going to perform an experiment 10,000 times and then look at what's the average outcome. And so the first experiment they trained this computer to do was to pick one stock out of the entire population of stocks, hold it up, measure its standard deviation of returns, and then throw it back in the pond. And they did that 10,000 times. And then they took the average standard deviation of returns. And they found that it was 49.24%. It's 49.24%. Okay, now they said, okay, thanks computer. Now we're going to move on to, you're going to pull two stocks out, and you're going to form, and then two stocks totally random. You're going to form a portfolio that's half this one and half this one. And you're going to hold that portfolio up, you're going to measure the standard deviation, and you're going to do that 10,000 times. You're going to throw those back when you're done. You're going to do that 10,000 times, and you're going to tell me the average standard deviation for that two-stock portfolio. And the answer was 37.36%. And they keep doing this with more and more and more stocks till they generate this whole column of standard deviation of annual portfolio returns. Now, the next column over is a ratio of the standard deviation of the portfolio in question compared to this one asset portfolio. One asset portfolio. Now, if we do the first one, of course, it's going to be 1.0, right? It's going to be 1.0 because It's comparing to itself. But the next one we can see is 0.76. In other words, I'm able to get rid of 24% of the risk simply by adding one stock to my portfolio. That's powerful. If I can, and this is just on average. On average, if I add one stock to my portfolio, I can get rid of 24% of the risk. That's pretty amazing. Now, let's see what happens if we double again. We're going to go from 2 to 4 stocks. Now we see that ratio is down to 0.60. By just adding 3 stocks to my portfolio over 1, I've now gotten rid of 40% of the risk. Isn't that amazing? We've already gotten rid of 40% of the risk. We only have 4 stocks in our portfolio. Now, I want to point out to you that these stocks were selected at random. We'll get to what happens if they're not randomly selected here in a little bit. Okay, now here's one thing I want you to notice though. As we doubled the first time, we got rid of 24%. As we doubled the next time, we went from 0.76 to 0.60. We only got rid of 16%. And forget 6, let's go to 8 up there. And now the next time, we're down to 0.51. So we've gotten rid of 49% of the risk. But that last doubling, instead of getting us 24%, 16%, it's only getting us 9%. And so there is a diminishing benefit to adding additional stocks to your portfolio. In fact, if you're only interested in that ratio out to 2 decimal places, it looks like when we get down to about 200 stocks, we've achieved the overwhelming majority of the benefit, and now it's just like really tiny incremental returns or a benefit to adding more stocks. But I do want you to notice something. Does the standard deviation of the portfolio continue to go down? It does. It just has less and less and less of an impact as we add more and more stocks. And so we have this declining impact of adding additional stocks. Okay, so if I ask you if you're going to go out and pick 200 stocks randomly, how many would you need to have a well-diversified portfolio? Based on the 2-digit ratios here, I think it's about 200, right? Okay, so let me tell you about my dad. My dad is a self-taught investor, but he's never had a class like this. But I was talking to him about his portfolio, and I said, "How many stocks do you have in your portfolio?" And he said, 12. I said, "Wow, you're terribly undiversified." And he said, "But they're all electric utility companies." Does that help? No, because we know, let's say for instance, that tomorrow they outlaw coal. What's going to happen? Every single one of his stocks is going to take a dive, right? Now what he's saying is electric utilities are historically safe, and he's right. But you can have these things that would just knock out his entire portfolio. Now, I said, "Why won't you add more than 12 stocks?" He says, 12 stocks is all that I can keep up with. I said, "What do you mean?" He says, "Well," he said, if you're not watching the stocks every day, you could lose everything." I'm like, "Well, Dad, don't you think the news gets priced into the stock before you find out about it?" And so my point to him is, don't follow 12 stocks every day, which he does. Of course, he's 81. He's got very little else to do with his time. What do I do instead? I own at least 1,100 stocks. Do you think I follow each one of those every day? No. In fact, how often do you think I actually check my portfolio balance? If you had to guess.
Monthly or quarterly?
So he says monthly or quarterly?
Weekly.
Weekly? What? Anybody else have another guess?
Twice a year.
Ooh, twice a year. Apparently, you guys think I'm more nervous than I am. I only check it once a year.
Wow.
Oh, yeah. Now, so let's think about why that might be. I don't plan to retire for another 15 years. And all that checking it on a daily basis does is make you what? Yeah, anxious. And sooner or later, your emotions get the best of you, like it did to my neighbor, and he sold out during COVID, and he hasn't got back in the market since. Now, it's starting to look like maybe he's going to get another chance to get back in where he got out. But my investing philosophy is I throw the same amount of money in every month. Every month. Month in, month out. Am I going to change that philosophy as a result of what yesterday's returns were? No. And so it really doesn't do me any good. The way that I invest is so much more relaxing than the way my dad invests, because I don't follow the stocks and I'm not exposed to a lot of this risk that he is. Does that make sense? Okay. Do you think I'll ever convince him to invest my way? Absolutely not. Okay, now for you visual learners, let's put this, if these are the same numbers from that last chart, and we're going to talk about two things here, diversifiable risk and undiversifiable risk. And basically, the line at the top, that curve, is total risk. The curve is total risk. Remember, we said total risk is standard deviation. And so we know that with one stock, we've got 49.2, and then it starts to drop. And what we see is that this thing becomes asymptotal. Asymptotal. The total risk becomes asymptotal. What does asymptotal mean? Ms. Volkova, what does asymptotal mean?
I would say it's a combination of the words symptoms and total.
Oh, so she probably learned it in another language, right?
I kind of know what it means, but I've been
Okay. Okay, an asymptote is a line that a curve gets close to but never quite touches. That's an asymptote. And if this curve is becoming asymptotal, it means it's approaching a line but it never quite touches. It's like you're landing an airplane and every quarter mile you drop a further half the distance to the runway. If you keep dropping half the remaining distance, will you ever actually land the plane? No. You'll get closer, 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 but you never will quite get there. Total risk is asymptotal. And where does it almost land but not quite? On systematic risk. On systematic risk, not unsystematic risk. That blue area up there represents systematic risk, which is why it's labeled up there as non-diversifiable risk. What's another name for that diversifiable risk in the brown? Yeah, it's the unsystematic risk. We can get rid of that junk by diversifying our portfolio. By the way, my dad buys individual stocks, one at a time, and he pays a commission for every stock that he buys. You say, well, wait a minute, wouldn't commissions kill you for owning 1,100 stocks? And the answer is no. I really only have to own two things in order to have 1,100 stocks in my portfolio. I have an S&P 500 ETF. I have an S&P 600 ETF. Throw those two things together, I've got 1,100 stocks, and I only had to make 2 transactions to get there. Does that make sense? Okay. Questions? So let's talk about measures of risk. I've already told you standard deviation is a measure of total risk, which is both unsystematic and systematic together. But the market's only concerned with systematic risk. And so what we need to do is get a measure of that. So we're going to develop this measure, and this measure is going to be called beta. And you can see beta is that curly B that the Greeks are fond of, beta. And we've already talked about why the market's only concerned with systematic risk. It was this argument right here. So let's talk about how we're going to get beta. Now keep in mind, last time we talked about the capital market line. That's the one that went from the risk-free asset to the market portfolio. Now we've got a second line to talk about. This is the characteristic line. And basically all we're doing to get our characteristic line is we're plotting the returns of the security on the vertical axis and the returns of the market on the horizontal axis. And that's going to form a line. And the slope of that line is going to be beta. Do you guys know about slope? So slope is equal to the change in y over the change in x, or as my grandfather would have said, rise over run. That's slope. And so this slope relates the returns on the market to the returns on, or the returns on the stock to the returns on the market. In this case, the slope of this line is 1.5. What does that mean? It means that if the market's up by 1%, the stock's going to be up by 1.5%. Because after all, we're looking at the change in the price of the stock divided by, or the change in the, change in the or return on the stock divided by the change in the return on, well anyway, it's comparing to the market. So, if we were looking at the market, what would the beta be? We'd be plotting the returns of the market on the vertical and the horizontal. And so what would the slope of the line be? It would just be 1. So there's your first fun fact of the day. The beta of the market portfolio is 1. The beta of the market portfolio is 1. Okay, so basically anything with a beta greater than 1 is riskier than the market. Anything with a beta less than 1 is safer than the market. My dad's electric utility stocks, where do you think their betas fall? Between 0 and 1 or between 1 and 3? Yeah, between 0 and 1. They're relative, and that's what he means by that's okay, they're all electric utilities, is because the beta is low. By the way, if I tell you how beta works, and you say, well, wait a minute, if the market's up 1 and you got a beta of 3, then the stock's up 3. That's pretty cool. And if the market's up 2, how much is my stock up? It's up 6. Sweet. What's the downside?
If the market's down.
Yeah, if the market goes down 1%, what's your 3 beta stock doing? Yeah, -3. And if it's down 2%, you're down -6%. So yeah, the big beta sounds all fun and games when we're in a bull market. And in fact, if you look at the time between COVID and very recently, what were people doing? They're piling into these high beta stocks because they think they're going to get rich, and because they've only been investing during times of the market going up, it's all paying off for them, right? But what happens when the market goes down? They're in a world of hurt. By the way, the market's down like 25% from its peak. A 3 beta stock, how much is it down? 75%. Does that make sense? Okay, so high beta is all fun and games until the market starts to go down on us. Questions? Okay, so now let's talk about some betas for some individual stocks. And the first one is one that my dad actually owns some of that. American Electric Power. It's an electric utility, 0.32. By the way, why do you think electric utilities are so safe from a systematic risk perspective?
Currently, we pretty much rely very heavily on electric.
We rely very heavily on electric, and there's basically 2 kinds of electric consumption. There's residential and there's industrial. In the United States, which one of those do you think predominates? The residential, right? And, you know, it's not like when times are bad, you go home and sit in the dark, right? You're going to turn on your lights. You're going to, if this is a water company, you're going to flush your toilet, I hope. You're going to shower, maybe a little less. But the point is this, when you look at these utility companies, they are not going to be swayed by these big increases or decreases in economic growth. Now let's look on to Johnson & Johnson. What do they do? What do they make? Medicine.
A lot of products.
Say again?
A lot of products.
A lot of products. That doesn't help. Okay, so let's talk about bandages. Johnson & Johnson, I think they own Band-Aids, I think. Do you cut your finger and you're bleeding really a lot and you're like, you know, I'd love to put a Band-Aid on that, but I'm not sure I'm going to have a job tomorrow. Nobody thinks like that, right? And so that's why you see Johnson & Johnson being a low beta stock. And in fact, we might call it a defensive stock. During bad economic times, people would buy that stock. They would get out of these high beta stocks and into stocks like that. So are utilities, by the way. Then we got Tyson Foods. Anybody know what Tyson Foods is really famous for? Chicken. Now, let's talk about chicken versus beef. Now, I know Tyson owns a beef processor, but let's just talk about chicken versus beef. It takes 4 pounds of grain to make 1 pound of chicken. It makes 10 pounds of grain to make 1 pound of beef. By necessity, which one's going to be more expensive?
Beef.
Beef. Now, what does that mean? That means that during bad economic times, what kind of meat can people afford?
Chicken.
Chicken. And when times get good, they don't order more chicken, right? They migrate to beef. You don't ever hear anybody say, yeah, I just got a huge promotion. Tonight I'm going out for chicken and lobster. Nobody says that. And so that's why Tyson, predominantly a chicken company, has such a low beta. And then there's Allstate. What does Allstate do? Insurance. And they're getting closer to being same risk as the market. By the way, what was the beta for market? 1. So everything we've talked about so far is less risky than the market. Now, let's move on to 3M. 3M is an industrial conglomerate. They make all sorts of different stuff. It makes all the sense in the world that they're basically as risky as the overall market. They're basically a huge diversified portfolio of very middle-of-the-road stuff. So it makes sense. What about Hewlett Packard and Dell? What do they do? Computers, right? Okay, so let me tell you how computer upgrades work. When times are tough, what do companies say about replacing their computers?
Nothing.
Yeah, they put a hold on that. And then when times are good, then they'll go ahead and do the upgrade. And so that means that these stocks are more sensitive to the economy than, say, toilet paper. Does that make sense? In fact, I remember working at the nuclear plant. We showed up one day, and there were these like pallets of brand new Dell computers. And we're like, what happened? And they said, well, we had a good year and we had some money left over, so we went out and bought computers. Does that make sense? Okay. And then finally, the last one here is an outlier. And the reason it's an outlier is because the time frame of this snapshot, I forget what year the snapshot was, but it was after the financial crisis. So during the financial crisis, AIG nearly went out of business. The stock price just crashes. The U.S. government steps in and bails them out, and eventually they get their money back plus make a profit. But they had to bail them out, so the stock price is very, very low. And then when things start to return to normal and AIG gets back into its regular business of insurance, the stock price starts to go up pretty fast. Is it going up fast because AIG is growing or this is all, is it very risky? No. It's going up because it's basically returning to its previous situation. I don't know if you've ever been in a swimming pool and you drag a float down to the bottom, something that floats, and then you let go. What happens? It goes and it goes up. It gets really fast, right? What if you're just holding it slightly below? The speed doesn't build like that. So what we were seeing there is that AIG was just basically going back up to where it should have been, and that's why it shows such a high beta. In fact, I'll bet if we went out today and looked at AIG's beta, it would not be that high. Now there is an important thing down here at the very bottom, and that is a definition of beta that you should surely have on your note sheet. It's a definition of beta that you should surely have on your note sheet. And it's the covariance. Here. Covariance of the returns on your stock with the returns on the market divided by the variance on the market. Now, if you remember that we had correlation is equal to covariance divided by standard deviation of returns on the market, standard deviation. So this is how we can do correlation. What if you're given correlation in a problem? What can you do? You can rearrange this and say covariance, the returns of the return of stock with the returns on the market is rho, not beta, times the standard deviation of returns on the stock and the standard deviation of returns on the market. And so then I can plug that in here. And it would just be correlation like that. Have I done anything mathematically illegal? It's just substitution principle. Now, here's the cool thing. What happens? Did I do anything illegal? No. And so what we've got here is correlation times the standard deviation of returns on the stocks divided by the standard deviation on the market. Now, if you're the kind of person that can't do that algebra during an exam, write this one down too. Does that make sense? And keep in mind, this is correlation and this is covariance. You have to read to know what they've given you. Questions? By the way, we keep talking about the returns on the market, and theoretically it should be that market portfolio, but we do not know the true market portfolio. We talked about that last time. So what do we use as our stand-in instead? We use the S&P 500. We typically use the S&P 500 for our returns on the market. Okay, now let's talk about calculating beta for a portfolio. It turns out it's just like calculating expected returns. So all you have to do is the weighted average of the betas gives you the beta of the entire portfolio. The weighted average of the betas gives you the beta for the entire portfolio. And so it's going to look something like this. Beta of the portfolio is equal to XA beta A plus X B beta B plus dot 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 plus X N beta N. And the sum of the x's is going to have to equal to 1. So that I is equal to 1 to n. So you're going to have to add all those x's together, and they always add to 1. The weights always add to 1. Now, this is just like what we've been talking about for finding the return of a portfolio. Previously, we said you couldn't do the weighted average of the standard deviations. That's a measure of risk. Why is it okay to do the weighted average of the betas? Isn't it also a measure of risk? The reason we couldn't do the weighted average of the standard deviations was because those contain unsystematic risk that can be diversified away. Can beta be diversified away? No. And so that's why it's just the weighted average. It's just the weighted average. Very simple. Now we're on to our third line that we're going to talk about today. The first was the capital market line from last time. Then the characteristic line. Now we're on to the security market line. And the security market line, just like some other lines we've looked at previously, has expected return on the vertical axis, and it has risk on the horizontal axis. Previously, this risk measure has been standard deviation, but now this risk measure is going to be beta. The risk measure now is beta. And we are going to construct this line using two things that we know. By the way, a line, in case you were asleep in high school geometry, you can draw a line through any 2 points that are not like one on top of another, right? And so all we need to define this line are 2 points. And the 2 points that we know two points that we know are the market portfolio and the risk-free asset. And we will talk about X and Y for these both. Okay, now the market portfolio. We said, what's the beta of the market portfolio? 1. What's the beta of the risk-free asset? The beta of the risk-free asset. If it's risk-free, 0. Very good. Okay, now over here on Y, it's not quite as easy. We're going to say that this is the expected return on the market portfolio. And the return on the risk-free asset will be the risk-free rate. Okay, so now we have 2 data points. 2 data points. All I need to define a line are 2 points. Okay, now I'm going to show you a formula. If you're an American, this formula looks like this. If you were trained outside of the US, it probably was like this. Was this how it was for you, the second one? Okay. What is that?
Slope.
Oh, you're getting close. Start.
Slope of the line.
The slope-intercept form of the line. It's the slope-intercept form of the line. Now, what is B in that formula? The y-intercept. The y-intercept is defined as the value of y when x is 0. Do we know what that is? Yeah, it's just the risk-free rate, isn't it? So basically, all we have to do now is figure out the slope of that line. That thing's crazy. Okay. The slope of the line. How am I going to do that? Slope is equal to y2 minus y1 divided by x2 minus x1. And just to make it come out pretty, I'm going to call this number 2 and this number 1. And it's just because I want that stuff to come out positive. If I did it the other way, both would come out negative, and what would happen to the negatives? Yeah, they just cancel out. So we're going to get the same answer either way. So, let's see, y2 minus y1 is the expected return on the market minus the risk-free rate divided by x2 minus x1, 1 minus 0. So what is 1 minus 0? 1. And if I divide by 1, what do I get? I just get the top part, right? And so basically what we're left is, this is the slope of the security market line. We have another name for this thing. It's the MRP, the market risk premium. The market risk premium. Remember earlier we said a risk premium is the expected return on something minus the risk-free rate. Well, the market risk premium is the expected return on the market minus the risk-free rate. And so, and this is a great test question, what is the slope of the security market line? It is the market risk premium. Now, what is the most common answer students put down for what is the slope of the security market line? They say it's beta. Most common wrong answer is beta. By the way, do you think I would have that in there too? Absolutely, because I am that cruel. Okay, so I'm going to say it one more time. The slope of the security market line is the market risk premium. So now we can go ahead and put all of this stuff together to come up with a statement of the security market line. In this case, Y is going to be the expected return on the stock, which is that horizontal or a vertical axis, is equal to, what's the slope? Expected return on the market minus the risk-free rate. And what are we multiplying that by? What's X? beta. And so that's going to be the beta on the individual stock. See, it's stock I, beta I. And then we're going to add the y-intercept, which we said was the risk-free rate. And so there is your security market line. However, typically, we state this a little differently. We say it's the expected return on security I is equal to, and we start with the risk-free rate, plus, and then sometimes we see beta first, expected return on the market, minus the risk-free rate. Are those mathematically identical? Yeah, they're mathematically identical. You can put either one of them on there on your sheet that you wanted to. Now, here's something I want to point out. This thing here is the market risk premium. When you're working problems involving this, you always want to read, are they giving me the expected return on the market, or are they giving me the market risk premium? Because if they're giving you the market risk premium, you don't have to subtract out the risk-free rate. If they aren't giving you, if they are giving you the expected return on the market, you have to subtract that out before you multiply by beta. Does that make sense? I want you to also notice that risk-free rate shows up twice in the equation. Okay. Now, let's talk about something else that I think is interesting, and that is what happens if we subtract the risk-free rate from both sides. This is what we get. And this thing is just the risk premium for the stock. So, if you want to know the risk premium for the stock, all you got to do is take the beta and multiply it by the market risk premium. And so if a stock has a beta of 3, its risk premium is going to be 3 times as much as that of the market. And that makes perfect sense because we know risk and reward have to go together. Does that make sense? Okay. Now let's go back and talk about different kinds of betas. I'm going to put this back the way it was. We said that the beta of the risk-free asset is 0. If I plug beta of 0 into this, what do I get?
The expected return is risk-free rate.
Yeah, the expected return is just the risk-free rate. Does that make sense? Sure does. Now, what if we have the market portfolio? What's the beta of the market portfolio?
1.
If I put a 1 in here, I get risk-free rate plus the expected return of the market minus the risk-free rate. What happens to the risk-free rate minus the risk-free rate? Cancels out, and the expected return of that item would be the expected return on the market, which would be exactly what we would expect. If beta is greater than 1, it's going to return more than the market. If beta is less than 1, it's going to return less than the market. Now, I don't recall in this particular edition of your textbook what they say, but I used to have one, and it's talked about negative beta stocks, and it gave some examples. And then the very next edition that came out said there's no such thing as negative beta stocks, which I thought was very interesting given what the last one had said. And so I thought, wow, maybe negative beta stocks have disappeared from existence. And so what did I do? I go out to my stock screener that my broker gives me for free, right? And I tell them I want to see all stocks with betas less than 0. And the kinds of stocks that showed up were gold mining stocks. Let's talk about why gold mining stocks might have a negative beta. When do people buy gold? When do people just really start jumping into gold? Is it during good times or bad times? Bad times, people are flying into gold. So what does that mean? It means as the market is taking a dump, what's happening to gold prices?
They're rising.
They're rising. Okay, that's the first step. Second step, think about a gold mining operation. Here we've got our mountain that we've been digging gold out of, and we're getting 100 kilograms a day. Oh, that would be a lot of gold. We're getting 100 grams a day out of this mine, and it really, I mean, we're paying our people $20 an hour, and we have to spend so much on electricity, but our costs really do not vary with the price of gold, do they? I mean, we've already bought the mountain. Okay, now think about what the profits look like at a gold mining company. Because the costs are staying pretty stable, as the price of gold goes up, what happens to the profits? Whew, yeah. And what happens if the price of gold goes down? Profits go down. And so the profits of the gold mine just basically directly go up and down with the price of gold. So follow the bouncing ball. The market's in bad shape, gold prices go up, gold mines are more profitable. At the same time, when the economy is bad, what's going on with the market? Oh, come on, if the economy is doing poorly, do you think we're all having a party on Wall Street?
No.
No, it goes the other way, right? So if the economy's bad, the market's down, and so it's both driven by the economy, the market's down, the gold mining stocks are up. They're moving in the opposite direction. Now, what happens when we start to get a little hope, when things start to get better? Do people want to hold on to their gold? No, and so they start to sell their gold to buy stock. What happens to the price of gold? It goes down. What happens to the price of stock?
Goes up.
It goes up, and so we're seeing these things move in opposite directions. So I have proven to you that negative beta stocks exist, and now I'm going to ask this question: what happens if beta is negative here? What happens to that expected return on that stock? It's well, it's not necessarily negative, but it's definitely less than the risk-free rate. Now, why on earth would I put up with a stock that offered me less than the risk-free rate when I could just invest my money in the risk-free asset? And the answer is when these stocks pay off. So, in good times, the economy's up, the market's up, and your portfolio is bigger at the same time that you're getting pay raises at work. This growth in your portfolio is certainly nice, but is it going to make the difference between you eating and you not? No. What about during bad economic times? So the market's down, your dog left, your pickup truck broke down. There's all sorts of bad things that go on there. What's that?
Would be a country
It
song?
could be. Oh, by the way, with the invention of self-driving cars, it's only a matter of time before we had a country song about a man's pickup truck leaving him. Back to the story. What we're talking. Oh, okay. So but the question is this: what are your negative beta stocks doing when all these bad things are going on in your life? Yeah, they're going up. Let's see, I'm going to have to ask for some help from my economist here. It's diminishing marginal utility of consumption. Does that sound familiar?
I think that's the class that I took during COVID.
What's that?
I think that's the class that I took during COVID.
Oh, okay. Okay, so I'll give you just a really, and of course you're not going to have to know the term. It's a diminishing marginal utility of consumption. So here's the trick. When you're very poor, the very next dollar that you earn, does it mean a lot to you or a little? A lot. Now, what about the next dollar? Does it mean quite as much as the first dollar?
A little less.
Little less, right? And so what we're saying here is the higher your income gets, the less that additional dollar means to you. Give you an example. The year's 1989. I'm in my dorm room with my buddy Derek. Derek's dad was a big deal civil engineer for an oil company. And he comes to our room and we're sitting around complaining about the price of books. And we complained about a book being $100. I know you guys are going to laugh that a $100 book costs us to complain because that's like on the low end for you, right? Okay, so we're complaining about this $100 book, and he says, his name is Earl, by the way. Earl said, I piss $100 up against the wall. Now, I thought two things. Number one, easy for you to say because you make $55,000 a year, which was big money in 1989. And the other thing that I thought was, piss my way, right? Because that $100 meant a whole lot more to me than him. Why did it mean more to me than him? Because I didn't. I had somewhere between jack and squat, right? Does that make sense? Now, that's why we are willing to put up with bad behavior from these negative beta stocks, because they pay off when we're hungry, cold, our life partner has left us, the dog has rabies, all the bad things in life, right? Questions? And we've talked about all that. And now we're on to doing linear regression on Excel. Now, by the way, is this something I can ask you to do during the exam?
No.
No. Does that mean you shouldn't? Stop that. Does that mean you shouldn't pay any attention? Stop that. No, you should pay attention because I'm going to be teaching you some stuff as we go along here. Okay. Now, so let's take this. What I already erased it. We're going to take the formula in this format. And in doing this, in linear regression, our intercept is going to be 0. So now I'm graphing the risk premium of the stock versus the risk premium on the market. Now, the stock we're going to work with is General Electric. The risk-free rate we're going to be working with is the 3-month U.S. Treasury bill. Now, where did I get the data for 3-month Treasury bill yields? From our friends at the Federal Reserve. By the way, there are 12 Federal Reserve banks. What is the only state to have 2?
Missouri.
Missouri. So if you ever need a point of pride for Missouri, there you go. We have 2 Federal Reserve banks. Okay. So I got that data from the Federal Reserve, and I went out to Yahoo Finance and got the prices from GE. Now, Yahoo does very little well anymore, but this is one of the few things they do well, and that is historical stock data. As long as the company is still surviving, it's out there. And so I was able to pull that data. And then I can use the prices on GE to figure the return. Because we know that the return is just equal to PT plus 1 minus P sub T divided by T sub T. Does that look familiar? That's all I did to come up with this return on GE. In fact, I'll click on it and you can see which cells I used. By the way, notice that these are in descending date. In other words, the very last date's the one at the end. Now I want you to notice that I have gone all the way down here, and my last price that I pulled was not in 2007. Oh my goodness, I feel old. It's been a long time since I pulled this data. It wasn't in 2007, it was in 2006. Any idea why? In order to I'll get you started. In order to calculate the return for today, what do I need to know about yesterday? I gotta know yesterday's price, right? And so in order to be able to figure out this return right here, I had to know yesterday's price. And in this case, yesterday means the last trading day. Does that make sense? By the way, typically 252 trading days in a year, unless we have a weird year or a terrorist attack. That's the only 2 things I can think of that have led to differences. Did you guys know that we shut down the stock market during the 2001? Yeah, okay. Now, back up here. Now so I've got the return on GE. I can figure out what is this risk premium on GE by subtracting out the risk-free rate. So all I have to do is take the return on the stock and subtract out that risk-free rate. Nothing major exciting there. Okay, now the next thing I need to know is I need a proxy for the market portfolio. A proxy is a stand-in, a substitute. It's not perfect, but it's the closest that we can get, or it's at least one that we all agree on. And the proxy we typically agree on is the S&P 500. Now, the day that I was out there pulling this data down, for the life of me, I could not find the S&P 500 in Yahoo Finance. But I could find SPY. Does anybody know what SPY is? It's an exchange-traded fund that represents the S&P 500. So if the S&P 500 is up 10%, this thing's up 10%. If the S&P 500 is down 2%, this thing's down 2%. Does that make sense? And so the returns on this thing are going to be the same as the returns on the S&P 500. So that's what I did. I grabbed it and I did exactly the same things with it that I did with GE. And so now I have the market risk premium, which is this column, and I have the risk premium on the stock, which is that column. So I've got this piece, and I've got this piece, and I'm going to use something called linear regression to determine this piece. Have you guys done linear regression before? Oh, wow. Excellent. Usually people have never heard of it. Okay. Now, linear regression, by the way, it's all about it's about creating a line that fits the data the best, right? So that's what we're going to do here. We're going to create a line that fits the data the best. Now, how do I do that in Excel? First thing I do is I go out here to data, and I see that they don't have the thing that I need, so which is not uncommon. I go to home? No. There we go. And I go down here to options. Where's options? Under what? Oh, more. Okay. So now what else do we have under options? We have add-ins. And what add-ins do we need here? So we're going for the analysis tool pack. I don't know the difference between this one and this one. I always just take the top one. But I can go down here and manage Excel add-ins and say go and just click on analysis tool pack and then go back to data. And there it is. Woo! Okay, now I double click on that and it gives me some choices. And there's all sorts of amazing stuff to do there, but the one we're interested in is regression. And they're telling me to input the Y range. Y in our equation is this, the risk premium on the stock. And so I'm going to start over here. And I'm going to go all the way down. What is that noise? Okay, and then I'm going to go over and input the X range, which is this thing over here. And I'm just going to say as a new worksheet page, so I'm just going to hit OK. And then we'll try to look these things over and see how we can interpret them. Okay, first thing I want to look at is R squared. Do you guys know what R squared is? Okay, so it has to do with how well does this line fit my data. And in fact, what we're saying here is that I can explain 60%, 0.60, I can explain 60% of the change in this based on the change in this. Now, you may think that an R square of 0.6 sounds low, and when I was in engineering school, we were looking for 0.97, 0.98. But we were dealing with physical phenomena. What we're dealing with here is, by the way, finance is a social science. Everything we're looking at here is as a result of interactions between people. Do you think people are as predictable or dependable as, say, cast iron?
Nope.
Absolutely not. Absolutely not. And so it's not strange to me to see 0.6. In fact, when you start looking at the correlation coefficients on some of the R squareds, on some of the big studies that we all hang our hats on, how many of you think smoking cigarettes causes lung cancer? Yeah, we all do, right? You know what the R squared on that study was?
Very.
0.04, 0.05. Right? Yeah. I'm not telling you to go out and smoke. It's still bad for you. Plus, it makes you stink. Don't do that. It makes your teeth yellow, too. Okay, so what I'm telling you is 60% is a victory. 60% is actually a victory here. Okay, now we're going to move on down here, and there is this thing called the F test. And so the significance of the F test, basically, we also call this p-value if, so there's that's the probability that this thing we've come up with, this beta we're calculating, is actually 0. Now, how do I read that number? That's scientific notation. It's 0.000, 50 zeros, 2. Is that a high probability that you'd like to bet money on? No, that's a damn near never going to happen kind of probability, right? Does that make sense? That's like winning the lottery kind of probability. Okay, so we're pretty sure that this thing has some significance to it. Now, when we get down to the bottom, x variable 1 is this, and it's calculated as 0.894. That would be the beta for GE at that time, 0.894. Now, what's the beta of the market? 1. GE, at the time, large industrial conglomerate in many different businesses. Does it make sense that they have a beta close to that of the market? Absolutely, it does. Now, let's talk about this intercept. Remember, I told you this intercept should be 0. Let's see how close to 0 we got. That intercept says -7 times 10 to the -5th. So here's what that would be. 0.00007. Is that pretty close to 0? Yeah, I think so. And so it actually worked out fairly well. Our intercept was very, very close to 0. So I would say that we have a successful estimation of our beta here. Now, should we take this number as an exact number that we should always know? What is this thing actually? 4-letter acronym starts with an S. What is it?
Swag.
It's a swag. Right? It's a swag. Because look at the R squared. There's basically a 60% chance this thing is right. Does that make sense? I mean, that's oversimplifying it, but the idea is this. If that R squared was 1.0, we could take this to the bank. But otherwise, it's a swag. It's not necessarily going to be exactly that. Questions? Okay, I managed to finish chapter 11 today. And so now you need to go do your homework, and if you have questions, let me know.